Welcome to This Week in Money. I'm Phil Mackesy. Today, Ross Clark wraps up the week in markets. David Smith looks at what's next for gold and silver. And Keith Schaefer updates us on the latest in oil and gas news. We begin with Ross Clark right after this.
It's all about money. At the HoweStreet.com Money Expo, they'll be talking money, making money, saving money, and protecting assets. See Ross Clark with technical analysis, Louis James on metals and mining, David Smith on the junior markets, video with Doug Casey and Danielle Park talking optimism and pessimism, plus silver guru David Morgan, and visit with industry exhibitors. The HoweStreet.com Money Expo in Victoria at the Conference Center Saturday, June 16th. To attend free, pre-register now at moneyexpo.ca. That's moneyexpo.ca or at the door. It's all about money.
Welcome to This Week in Money, the source for market opinions, brought to you by AmericanManganeseInc.com. Here is Phil Mackesy.
Ross Clark with CIBC Wood Gundy is our guest. You can see Ross and his amazing charts at Money Expo, Saturday, June 16th at the Victoria Conference Center. You can register now at moneyexpo.ca. Another wild week, Ross, and a great time to talk about the charts you're going to be showing. Are they going to help us make some sense out of all this?
Well, I'm hoping so. We've got the charts give us parameters to work around, and clearly there's enough market action, enough volatility going on here right now that if we can try and pick some extreme levels that would be of significance, that's the name of the game.
Now, you always get a lot of questions after the show, and that's one of the things I like about your presentation is it makes people think about what's going on, and people come up and ask you after the show, oh, what do we do now, Ross?
Yeah, well, we touch on everything from equities to bonds to the currencies and the metals, and show how there are various approaches, various techniques that can be used both in terms of the long term and the short term, and how with each of these markets, they have their little idiosyncrasies, and therefore you treat them just a little bit differently. And we're there to try and educate people, give them some tools to work forward with, rather than just a current opinion. We'll give that as well, but give them some tools that they can use when they get back home.
I've seen your presentation a couple of times. One of the things I like is that it helps take some of the emotion out of investing.
Well, we could never get all of that out of the marketplace. There's no question about that. One of the keys that I try and work with, and a couple of the indicators that we look at are oscillators that will jump out when markets are at extremes and then those highly emotional times, to try and recognize when a market may be susceptible to a reversal, and the idea being there that you want to be a contrarian at those times, but a contrarian that's got some money management.
We're talking to Ross Clark from CIBC Wood Gundy here on This Week in Money. And speaking of what's going on this week, U.S. stocks headed for one of the best weeks of the year. The Dow up almost 400. Markets kind of basking in the afterglow of the Bernanke effect, but they're kind of worried about Spain, and they should be. It is the fourth largest economy in the Eurozone.
Right, and the bond auction, they went reasonably well there this week. However, we've got still ongoing concerns as far as the banking side of things is concerned. This weekend, there's talk that there may be some cash that's brought in to recapitalize some of them and try and ease through. But, this is still part of, we talked about, a big ongoing problem in Europe. We've moved from Greece as the headline to Spain, and this is a long way from being over. You're going to have good and bad days, and who knows? Every morning we walk in, and it's a bit of a casino.
Yeah, it's not been a good week for Spain. Fitch Ratings slashing Spain's credit rating to BBB. That's just short of junk status for them.
Right. Do we have many surprises here?
No.
No, I don't think so. And on the other side of the coin, you go across into Asia, and you've got China dropping interest rates this week, quarter of a point. That's ahead of economic news this weekend. So, I would suspect that the news is going to be on the soft side. You've got Bernanke, sort of a little bit opposite to other members of the Fed. His comments this week saying that really stimulus may not be needed at this point. Markets and economies a little better than they had originally thought. boy, talk about getting mixed signals everywhere.
Are we looking at a typical spring summer here, Russ?
Well, you tend to we talk about best 6 months of the year being that October through the end of April, and that it tends to be nicely market driven in terms of earnings and steady information flow. And through the summer, it tends to be a much more mixed bag. You don't get as many positive items coming through. And so what we're seeing right now is part of the normal chatter that you see in the summer, which would typically have at least one good sell-off. Clearly, we've had one. It's been 10% in the U.S. It's been much larger than that in terms of Canada. But this thrashing around is not unusual for the summer period. And, look at last Friday, after the bad employment numbers in the States, the markets all gapped down. They stayed down for 3 days, and Wednesday morning they gapped right back up on the stimulative news out of China. What we've left behind here is an island, technically, in the U.S. markets. The gap down 3 days and then gapping back up. That's type of an exhaustion signal that you see at significant turns, and typically you would get a good 3 or 4 day run as far as the market's concerned. And I think if it hadn't been for Bernanke yesterday, we probably would have been trading up into the, we're at 13.15 on the S&P. We probably would have been trading up into the 13.50 or 60 range. I still think that's attainable on this bounce right now.
Do you feel, like everybody else, a little disappointed in what Bernanke said? I guess our expectations were set up a little high to begin with, weren't they?
Well, I mean, expectations, people, they're saying they want some monetary easing. They want the QE3, but really, is that good? I mean, ideally, you want an economy that will grow out of a recession by itself. Yeah. Now, that's not really feasible at this point. The debt side of the equation is just much, much too large to be able to get through that. But everybody seems to want to be given things on a platter, and it's just not going to be that way. This is going to be a grinding period. I still think that this 12-year consolidation that we've been in since 2000, that we've got more of this to go forward with, and the markets will be choppy. They'll be very selective in terms of which sectors are moving. But it's a deleveraging phase that we're in.
We got a couple of weeks going to the FOMC meeting where they announced more monetary policy. Any changes between now and then?
Any changes? I would, it's going to be a matter of just what economic numbers come up in this time period. I don't see that you would, from what Bernanke has said this week, it would be surprising to see them make any significant moves on the 20th.
Ross Clark from CIBC Wood Gundy, our guest on This Week in Money. Let's talk commodities for a second. Oil continuing to slide, now down below $83 a barrel. Get this, the last time oil closed below $83, Ross, in October of last year.
Right, and the number of consecutive weeks here on the downside is just becoming very, very excessive. This is one that caught me off guard. I thought when we got off to a good start the first part of this year that it would be stair-stepping its way higher, but now we're at the point where one looks at it and says, have we reached the bottom? And this $80 range is clearly excessive enough that one should be looking, I think, for some stability, maybe in the, let's call it a $78 to $84 range.
We are talking to Russ Clark from CIBC Wood Gundy here on This Week in Money. And let's talk about the other commodity, gold. Gold down about 2% this week. The China decision, of course, a factor, and the stimulus thing also important for gold.
Oh, yeah. I mean, we all remember the 29th of February, which was another bad hit day as far as gold was concerned, and that was another Bernanke day of testimony. And we're stuck in this trading range as far as the bullion is concerned. You've got the 1640 is your first level of resistance, and now I would say that the 1560 to 1570 is the important support that we want to see hold. My technical still showed that following a late May low, we would have buoyancy into July. We need to see, to put this market back in a really healthy mode, we need to see prices trade up and close into the high 1600s. We've spent the better part of, 10 months now in the 1500 level or so, and it's getting tired up here. And unless it gets some legs and starts running, I think we could end up with a deeper correction.
If history is any teacher, what have past events taught us about gold and where it's at this point? Well,
We've got 5 consecutive weeks now where both the 20 and the 50-week averages are trending down. And if they cross, and right now there's about a $15 difference between them, if they cross, then the implication is that we would drop all the way to the 50-month moving average. That's down around $1,300. Now the cross itself usually happens as the markets are hitting an interim low, and you generally get a bit of a bounce back. Okay. But the fact is that if you do get that crossover, it tends to lead to much more to the downside. So we plug the numbers in right now. If we spent another 3 or 4 weeks here, moving average will have crossed. So as I say, to get this market back in healthy condition, we really want to see that move through a nice close through 1700 would help us a long way.
What about silver, Ross? It almost hit 30 this week. It's back off a little bit, but it's kind of reacting to what's going on as well.
It's reacted decently. The gold-silver ratio really hasn't done much there in terms of the silver, and that coming off a good bottom, you would look to see silver be a leader. We don't have that as of yet, so that's one of those parameters that people might want to keep an eye on. On any given day, just take a look at the net changes on a percentage basis. Here we are today. Gold is, as we talk, up about $1.20, so that's 0.8%. Silver market's down 12 cents. That's down 0.4%. For a strong market, you want to see that flip around the other way.
Ross Clark from CIBC Wood Gundy, our guest here on This Week in Money. One of our favorite themes all year has been the miners and how they have been lagging the price of the metals themselves. Nice bounce last week. What they do this week, and what do we look for?
A great bounce this week. Actually led the market off the lows, and as we ended up with that triple bottom on gold over a span of 3 weeks, the miners were stair-stepping their way up. There's I would say 90% of them are in well-established downtrends, and they're just coming back from being oversold. Most of them are in the last 48 hours up to what I would call first resistance levels, and I would expect to see them consolidate and then maybe have a second run in the middle to second half of this month. There are a handful that we monitor, and I put out some charts earlier this week for people. There's a handful that are still through this whole poor stage of market action that we've had this year that have managed to hold above the levels of last September, October, above their 200-day moving averages, and those are the ones that I think people should be looking at as prime opportunities in the next few days.
Now, without mentioning any specific names, most of these companies fundamentally look pretty good, are pretty healthy financially.
Oh yes, yeah, and that's typically why they are there. These are companies that have gone out and raised cash at appropriate times, or they have, one of them in particular has got good solid cash flow and has no need to come to the market, and just hit a new all-time high this week.
Ross, how do we get a hold of you?
In Vancouver, my direct line is 604-661-7759.
And you can see Ross at Money Expo. That's Saturday, June 16th in Victoria at the Victoria Conference Center. You can register now at moneyexpo.ca. Ross Clark, thank you very much.
Thank you, Phil.
Coming up, David Smith on This Week in Money.
Always consult your investment professional before making any investment decision.
It's all about money. At the HoweStreet.com Money Expo, they'll be talking money, making money, saving money, and protecting assets. See Ross Clark with technical analysis, Louis James on metals and mining, David Smith on the junior markets, video with Doug Casey and Danielle Park talking optimism and pessimism, plus silver guru David Morgan, and visit with industry exhibitors. The HoweStreet.com Money Expo in Victoria at the Conference Center Saturday, June 16th. To attend free, pre-register now at moneyexpo.ca. That's moneyexpo.ca or at the door. It's all about money.
This Week in Money is archived online at talkdigitalnetwork.com.
David Smith is a precious metals analyst and frequent contributor to The Morgan Report at silver-investor.com. He joins us from his home in Seattle, Washington. Hey, David, it's good to have you back on This Week in Money.
It's great to be back again, Phil. How are you doing today?
I'm doing fine. You are just back from the World Resource Investment Conference here in Vancouver last weekend. What was the buzz? What were people talking about and thinking about?
You know, it was pretty interesting, just kind of feeling and listening to the energy there. There were fewer presenters than normal in terms of the booths, and some of them had kind of doubled or tripled up. And then also we had, I think, a lower customer count overall, which is kind of what you expect when the metals have been kind of weak lately. But the presenters learned a lot from several of them in particular and really enjoyed listening to what they had to say.
Now, I guess there's two ways of looking at the situation. Either we're getting slaughtered here and nobody cares, or there is an opportunity and everybody should care. Where do we stand in the continuum?
I would say that there's an opportunity, and by definition, when the convention halls are overflowing and everybody is there, a lot of new faces and things like that, that's usually an intermediate top, and that's proven to be the case just about every time. But when you have a situation like we saw this last week, I would say people that want to have a position or add to it should do some serious research and decide to take some kind of movement action here.
We're talking to David Smith on This Week in Money, and let's not forget you're coming up on an appearance in Victoria next Saturday, Money Expo at the Victoria Conference Center. You can register at moneyexpo.ca. How about a quick thumbnail sketch, a sneak preview of what you're going to be talking about there?
Well, I'm going to be talking about the ways in which you can amass, hopefully, large profits in gold and silver and mining stocks, and looking at the ETFs. And we're going to discuss the psychological aspects of what a person needs to really deal with. They have to understand the overriding factor in the markets, which is sentiment, and that's the sum total of all the actions of everything from fear to greed and in between in the market. They need to understand how the market deals with that and how they themselves deal with that. So knowing thyself first is one of the first rules to successful investing.
Let's take a quick look at our precious metals report card for the year. Gold up $20 here to date. It seems pretty much range-bound. A nice week last week, not a good week this week, down 2.5%, mostly based on actions from the Fed and the ECB, who both said, we're not going to do that much stimulus. That obviously not good for gold in the short term.
That can be viewed that way, but we had a very strong week last week and into the first part of this week, and I'd say it's digesting some of those gains. The mining stocks have been relatively held up quite well. Newmont is a bellwether producer, very profitable stock, actually bottomed about 2 weeks ago, and so I'm not sure where it closed today, but the thing is, the stronger members of the complex are either putting in bottoms, I believe, intermediate-term bottoms, or they're simply starting to move on up. I know one silver stock I follow was up almost 40% this week from a week and a half ago.
What's the outlook for bullion? What do we see going forward with gold?
From what I've heard, the bullion market remains pretty strong in terms of people buying gold and silver, and that's the thing, there's this constant subterranean warfare going on between the very public price of paper gold and silver and the less public price of the actual physical volume that's taking place, and I think eventually the real market, which as opposed to the paper market, is going to win out. But the government has a tremendous vested interest in having people remain confident in their fiat paper money. So there's all sorts of things to take on behind the scenes by big brokerage houses that are really kind of a de facto arm of the government that move these paper products around, and they can actually purchase and sell almost unlimited quantities of future prices, which tends to obscure what's really going on with the individual and the smaller fund and even the larger fund now investors.
We're talking to David Smith on This Week in Money, and the other big gold news this week. China, the world's biggest gold buyer, releasing some key economic data this weekend. And, of course, the Chinese central bank cut rates earlier this week. First time in almost 3 years. They've obviously got to be looking at these numbers in advance and seeing some kind of weakness in the data.
I think so. And, the thinking is that if they see a certain level of weakness, that they're going to stimulate their own economies by printing more money as well, too. And that's kind of the knee-jerk reaction of any government when their metrics fall below what they want to see them as.
Now, we won't know the effects on markets, obviously, or metals until Monday. What happens if those numbers aren't as strong as all the economists think they will be? What will that do to gold?
Well, in the short term, it may sell off. But the thing is, you got to remember there are a lot of pretty significant players that are out there buying the metals. Mm-hmm. And one thing that I really haven't heard discussed in terms of a really straightforward manner, and I think it's because it's underappreciated, and that is all the problems that are going on in Europe. First of all, it was just a thing about Greece, and now it's a thing about Spain, and there are other, Britain is having some real issues too in terms of their balance of payments and where they may be headed. And I think you're going to see kind of a spontaneous development, which I think is really underway by Europeans in general, gravitating more toward gold and silver as a way to hold on to some of their assets and not have them depreciated away or even put in a position where they don't have access to them. And of course, on some of the metals, you have to pay a VAT tax and everything else, and so that's more expensive for them. But also, there are new ways, some of which have come about very recently, where Europeans can hold metals and basically offshore in a way that they don't actually take delivery of them, and they can avoid the VAT tax in terms of buying and selling their physical metal holdings.
David Smith, our guest on This Week in Money, and let's talk about silver. It is up 40 cents year to date. Last week, a big jump for silver after that dismal labor news. This week, it broke through that resistance level of $29 and then dropped back down after the Fed statement.
It did, and then today, which was a relatively quiet day overall, just in round figures, I just took a quick look here this morning, and I think silver had been at one point about 60 cents lower intraday, and then closed up off of that by about 55, 60 cents from where that was. So it closed near the highs of the day, not a big range day, but still, to me, showing underlying strength in there. And I think that, the bears have to be careful in here, even if it looks like it's going to break support, and they might get caught in a bear trap if they're not careful.
Where are we going from here? Do you feel like David Morgan says, well, we're going to see $40 silver in this year?
I think it's a very real possibility. And, of course, when silver gets going, it really can take its own lead. But, this level and the $26, $28 has been tested several times now, going back to last fall. In fact, the day that David was speaking at the Utah Monetary Conference, I was down there with him, and that's when it tested it the first time. And so, it's come back to this area, and it uncovers a lot of buying support each time. So even if it were to go lower, if a person doesn't have a position now, taking a partial position now, to me, seems to be a very wise thing to do. And then if you get a chance to buy some lower, so be it. And if not, and if this is the bottom, then you won't be left holding the bag rather than some physical silver.
David, anybody who's not into physical gold and silver probably owns one of the ETFs, the GLD and the SLV. The GLD up 2% year to date, the SLV up 3% year to date. Does that surprise you?
Not too much. And of course, these different ETFs don't always exactly track the metals. What I like to do, I like these. I'm a little less risk averse, I guess you might say. I like the ones that are the leveraged ETFs, not with all my trading, but some of it, like the AGQ, which is a leveraged 2x silver ETF, which moves twice the speed of up and down of the silver. And then you have a gold equivalent, and then of course you have a stock equivalent, which is Nugget, NUGT, which is 3x to the primary mining companies.
I like that, NUGT.
Right, and if you want to short it, you just buy DUST, dust.
David Smith, the precious metals analyst here on This Week in Money. And according to David Morgan, a lot of folks believe this, and we want to talk about the miners. David says the mining stocks may have bottomed, and you can look at that with the, with the two big mining ETFs, starting with the GDX. It is down 10% year to date. That, of course, no surprise.
Yes, and I listened to David speak. He gave an excellent talk at the conference, and he did say that he believes that the mining stocks as a whole, as a group, have bottomed in here. The metal may or may not be at the bottom, but we're sure at a place where the downside risk is quantifiable rather than some massive cliff that we're staring over.
And the GDX, the junior ETF, down 15% year to date.
Right, and the GDX has been very responsive at turning around on a dime, so it acts like it just wants a tiny little reason to go higher, and it will, and it'll leave a lot of people behind that keep thinking that they can, get the bottom dollar.
We're talking to David Smith on This Week in Money. We're all familiar with the things driving gold and silver, China, Europe, and the U.S. Economy bogged down in what we think is some kind of a recession. Good for gold and silver. What happens next for gold and silver? What kind of things are going to be driving gold and silver and the bullion in the future?
Well, certainly people will be looking at physical demand, both domestically and in Asia. But with China and India, India has always been a big consumer of silver. But with China lately moving up, according to the recent silver survey, from being basically tripling their consumption from 15, 20 years ago and quintupling their production, and almost all that production is staying in-house, so to speak. So I think more and more it's going to become the Asian story of what their consumption is and their production. We're going to be watching that more and more. Just like a few years ago, 75% of the aerial traffic was between Europe and North America, and now it's 50-50. So a lot of people are traveling in other places to Asia and to South America rather than just Europe and North America. And I think you're going to see that same shifting of the demand quotient from the North American, European market to the Asian markets.
David, I've asked you this question before, but people keep asking me the same question. What is the difference between investing in gold and investing in silver? What should I be aware of?
Well, you could look at it several different ways, but one very simple way, I think, and I think David Morgan was one of the first to say this. He said that gold is wanted, but silver is needed, and that tells you quite a bit. Gold is a hedge against disaster and inflation, and also against depreciation of the assets of the currency, which is what's going on now big time in Argentina. But silver is, and a little bit of gold is used in industrial applications, and of course jewelry a fair amount. But silver is an industrial metal, and it's also an investment metal, so it has two faces, and that's sometimes why it's difficult to tease out what's going on with silver, because it's hard to get a handle in the short term on what's going on with consumption industrially versus the investment demand. But they complement each other, and I think if a person can, they should have some of each.
Okay. Is there a balance that I should be looking for between physical metals and ETFs?
Well, the first part of your foundation, your investment foundation, should be physical metal that you have either allocated in your name or actually physically under your control. And then after that, because you have a higher level of risk. For example, if you buy physical gold and silver, and I'm not talking numismatics, but I'm talking bullion coins and this type of thing, or small ingots, you're pretty much watching the price of it. If gold goes up, the value of your holding goes up, and of course the spread can change. The premium might go up and down, but basically, if silver is much higher or gold is much higher in a given time, and you bought it at an earlier time, you've got a nice profit. But you can buy a mining stock, and they're supposedly they go faster than the metal, but lately they have not. The last few years they've underperformed. But you can have one of the best stocks on the board, and if they have a mine shaft collapse, or if there's a labor dispute, or they have cost overruns on the production, that stock can really suffer in the short term. So you're accepting a higher degree of risk in order to hopefully make a higher percentage of profit. And that has not been true for most of the miners over the last few years, but I really think that's going to start to change. You
couldn't walk around at the World Resource Investment Conference without bumping into people who work for the different miners. What was the mood among the mining companies at the show?
Well, it reminds me a lot of all of us when we enter some type of a recession, that if we still have a job, some people just hunker down and they just kind of wait things out, and they may or may not be glum, but they're very careful about what they spend. And of course, that's good. But also, there's another type of person, and I like to think that I'm part of this too, and I'm not saying it's easy, but I think it really matters over the longer run. What I try to do when times are kind of hard and the money is not there as much, I try to get better at what I'm doing so that I provide more value for my clients, and so that I do a better job and I can work more efficiently, because I feel that when things turn around and there are better days ahead, I'll be positioned to present a very strong professional face to the people I work with and for new clients. And that means sometimes I have to spend a little money to upgrade my equipment or take courses to increase my learning.
Okay.
And I think that the more progressive mining companies are the same way. They're cutting back on their burn rate. I know several companies that really have very large projects, and they're operating with 4 people in the office, and they maybe had 12 or 15 before. But they're concentrating on really rationalizing the money that they spend, being careful with their drill holes and things like this, and they're going to keep on adding incremental value to their property. And then when sentiment improves, when the investor comes back in, they'll be ready again to have a strong professional face.
David Smith is our guest. He is a precious metals analyst and frequent contributor to the Morgan Report at silver-investor.com. Don't forget, David's at Money Expo in Victoria next Saturday, June 16th. You can register at moneyexpo.ca. David, as always, it is a pleasure talking to you. Thank you, sir.
Very good. Looking forward to Victoria. Take care and have a great weekend.
After the break, Keith Schaefer on This Week in Money.
It's all about money. At the HoweStreet.com Money Expo, they'll be talking money, making money, saving money, and protecting assets. See Ross Clark with technical analysis, Louis James on metals and mining, David Smith on the junior markets, video with Doug Casey and Danielle Park talking optimism and pessimism, plus silver guru David Morgan, and visit with industry exhibitors. The HoweStreet.com Money Expo in Victoria at the Conference Center Saturday, June 16th. To attend free, pre-register now at moneyexpo.ca. That's moneyexpo.ca or at the door. It's all about money.
This Week in Money is archived online at talkdigitalnetwork.com.
Keith Schaefer is our go-to guy for oil and gas. He's editor and publisher of the Oil and Gas Investments Bulletin. It's an independent research service, and he's online at oilandgas-investments.com. Hey, Keith, how are you doing?
I'm doing great, Phil. Thanks for having me on.
World Resource Investment Conference just wrapped here in Vancouver. Not everybody talking about gold. You were on a panel with Jim Letourneau and Joe Hung from Casey Research talking about oil and gas. How did that go?
Well, I think everybody was kind of agreed here that the future has become very murky for a couple of reasons. Obviously, the European debt drama. Oil moves up and down with the market, so there really is no clarity on where the market or oil prices are going until Europe is done fixing its problems, or at least showed the market that they can get a handle on their debt problems. And the other thing that came out on the panel was, Canadian and American supply is really picking up right now, particularly down in Texas and North Dakota. So you're seeing a huge amount of new supply come on stream very, very quickly. So it's not just the macro scene that's causing oil to drop right now. You're seeing, particularly in North America, a big new supply come out of Texas, North Dakota, and even Canada here with our own shale stuff and the oil sands.
So both those things are bearish for the oil price, I'm assuming.
Yes, very bearish. I think that the amount of supply coming out of North America has continued to surprise to the upside. So a few months ago, when everyone started to get a handle on just what this could mean, really what we're seeing now is that the projections are just getting higher and higher, and the curve in terms of production is just going up and up. So every estimate that we had here a year ago, 6 months ago now, it looks like we're going to beat those. So I think that the market is really kind of waiting to see now what happens with all this new production before they really get back into the market in a big way.
It always gets back to supply and demand, right? We've got some news this week from the Institute for Supply Management. The Purchasing Managers Index went up a little bit in May, and that kind of gives us hope that maybe the U.S. economy is recovering. But if it goes the other way, that's not good for oil either, right?
No, definitely oil. The oil price goes with the economy.
We're talking to Keith Schaefer from oilandgas-investments.com. Here on This Week in Money, a couple of news items that are catching our attention. Stuff from the Canadian Association of Petroleum Producers here, saying Alberta oil sands production will almost triple by 2025. Can you imagine that? Is that logical?
It is. The amount of supply out there is absolutely huge, and the industry has shown that they're just getting better and better, reducing costs and moving forward and developing the oil sands. Of course, our big challenge, Phil, is going to be getting it to market, and there are different pipelines that are now being proposed. One to the West Coast, the Northern Gateway pipeline, to ship some of this oil to Asia and get a much better price than we're currently getting here in North America. And of course, there's the Keystone pipeline to head down to the Gulf Coast, because a lot of the refineries in the Gulf Coast are geared towards heavy oil, and it's not really easy for them to switch to become a light oil refinery to handle all the new Bakken or the new Texas crude. So they're fairly committed to taking either Venezuelan heavy oil, Mexican heavy oil, or Canadian heavy oil. So we really have to get these pipelines built to make sure that our oil gets produced, because the reality is that if we don't get this stuff done, all that production is going to have nowhere to go, and Canadian oil prices are going to have a severe discount from oversupply.
Got a lot of news, a lot of reports this week. Here's a new one from energy consultants Wood Mackenzie, talking about the Bakken, saying it's competing directly with the oil sands and could keep oil prices low here in Canada, or at least international oil prices low.
I think there's a very real danger that Canada could really get the short end of the stick in the North American refining world. So, like I say, it is not easy for these refineries to switch from heavy to light oil, but they can. So we really need to be able to get our crude down to the Gulf Coast where the big refinery complex is, or somebody else is going to do that, and then it doesn't matter how much oil we got here if we can't get it produced and exported.
We got news from ExxonMobil, CEO Rex Tillerson. He's in the news. He says despite what's going on in the oil market on a day-to-day basis, that's not going to hurt Exxon over the long term. Is he being overly optimistic, you think?
No, I don't think so. I think the big thing here is, they've obviously got economies of scale, Phil, that allow them to have a pretty decent cost on their oil, and demand is not collapsing. I think that's really his big message, is that, energy use in the States is down a little bit. China's starting to go a little bit flatter. But Southeast Asia still looks quite good.
Okay.
Latin America still looks good, though it's truthful that everything's slowing. But overall demand is still doing fairly well. So the industrialization of Asia is still happening, and that's going to continue to drive energy demand.
We're talking to Keith Schaefer from oilandgas-investments.com here on This Week in Money. And still with Exxon and Rex Tillerson talking about LNG. I did not know that Exxon is North America's largest natural gas producer. They bought a company called XTO a couple of years back, and they're now in the natural gas business in a big, big way.
Yes, what's happened now is actually a lot of the oil companies, Shell is the same thing. They've become a lot bigger in natural gas, and that's for a couple of reasons. Certainly on the oil side, it's been much more difficult for these big companies to get big fields anymore. So with the shale gas phenomena, they are able to get big fields. They were able to buy their way into this industry, and now what's happening is that, to me, this is very positive, because the big guys in the market, nothing moves ahead in any industry until the big guys figure out how they can make money on it. So the fact that the big oil companies, who are generally the biggest companies in the world, are now very committed and incentivized to see natural gas products get developed and that market get developed. So I think you're going to see that. I think you're going to see the switch towards natural gas, both in power and transportation, just keep moving forward. These guys now have a lot of incentive to make that happen.
Keith Schaefer with us on This Week in Money, and natural gas prices climbing this week. The reason, of course, warm weather all across the U.S. and U.S. Northeast and Midwest next week. That's going to bump demand up, and that's got to affect nat gas prices from a positive standpoint, I would think.
Absolutely. I think the market, however, is kind of looking at that as a fairly short-term phenomena. Weather definitely has the biggest impact on natural gas prices, but the reality is now there's a big glass ceiling on natural gas prices because of the huge glut of supply, all the shale wells that are still producing quite high. So you've got almost no decrease in production here, and you've got what has saved natural gas prices from completely collapsing over the last 4 weeks or even 3 months or so is electricity generation has switched from coal to gas. So that's still happening right now. That's saving the natural gas price. Otherwise, it would be a lot lower in the United States right now.
More with Keith Schaefer next on This Week in Money.
It's all about money. At the HoweStreet.com Money Expo, they'll be talking money, making money, saving money, and protecting assets. See Ross Clark with technical analysis, Louis James on metals and mining, David Smith on the junior markets, video with Doug Casey and Danielle Park talking optimism and pessimism, plus silver guru David Morgan, and visit with industry exhibitors. The HoweStreet.com Money Expo in Victoria at the Conference Center Saturday, June 16th. To attend free, pre-register now at moneyexpo.ca. That's moneyexpo.ca or at the door. It's all about money.
This Week in Money is archived online at talkdigitalnetwork.com.
We are talking to Keith Schaefer here on This Week in Money. A whole bunch of reports this week. Here's another one from the International Energy Agency. They're saying global demand for natural gas should grow pretty healthy over the next 5 years, hoping that Chinese consumption of natural gas is going to increase.
I think that's true. I think you're seeing in Asia in particular, obviously the LNG boom is going very well over there. Japan, South Korea are really leading that charge, increasing their imports quite dramatically. And the world is really hoping that China can move that way too, because right now they're burning a lot of dirty brown coal, and it's just not great for the environment. And so there's a lot of pressure on the Chinese because they do have a large amount of shale gas reserves, but they don't have all the technology and the know-how to get it developed. So everybody's relatively hopeful that they'll be able to move forward on their natural gas usage. It helps clean up the environment, it's clean burning fuel, and it's cheap because they got lots of it in-house.
Now, once they get that production going, that could be kind of a warning sign for us here in British Columbia. The IEA study mentioning BC by name, saying while our exports may begin by 2020, it's a long way off, the growth is going to be limited because of what's happening over in Asia. They're going to have their own supply. Maybe we're a little too optimistic about the timetable here.
You know, I think that puts a lot of pressure on our industry and our politicians, both provincial and federal, to get the ball moving here and get these LNG plants going. I was really surprised this week to hear that Shell was talking about, I hope we're going to get our first LNG plant going and producing by the end of the decade. Well, boys, that's going to be too late.
Yeah.
Australia, Qatar, Indonesia, Malaysia, they'll all be exporting natural gas to Japan, China, and South Korea and Taiwan by then, and we'll be left eating the dust. We need that market desperately because the U.S., our main market, is basically being slowly, well, not so slowly, shut off to us. Imports, Canadian imports into the U.S. are down like 3 billion cubic feet a day this year.
Wow.
So like that's a big drop. We need that Asian market. So I'm really hoping that the West Coast proposals for LNG exports out of Canada get approved and get built very quickly.
The latest thing we're seeing from TransCanada Pipeline, Shell Canada, and 3 Asian partners, that $4 billion pipeline. And again, they're talking about the end of the decade here.
Well, yeah, that's what I mean. I think that it's really difficult to hear that talk when it's really essential, I think, in terms of getting a strong market presence over there, because the Japanese and the Taiwanese, yes, they want some diversification of supply, because right now it's mostly Qatar and Australia, but if anybody else comes up, they're basically going to have 3 or 4 suppliers already set, and that's going to leave us knocking at the door out in the cold wondering what happened.
We're talking to Keith Schaefer here on This Week in Money, and we talked earlier about Shell. Here's Shell CEO Peter Voser says he expects global LNG demand to double, Keith, by 2025.
I hope so. Makes a lot of sense. You know, the reality is that with the technology now, with these LNG carriers and the floating import terminals that they've built called FSRUs, floating storage and regasification units, they can really move LNG in a global market now. They can process it cheaply. They can regasify it cheaply. So everything's falling into place for this to be a major global industry.
It is study week, or so you would think. Here's a new one, Keith, sponsored by the American Natural Gas Alliance and the American Petroleum Institute. They say greenhouse gas emissions from nat gas production about half what the EPA estimated, and they've got a huge sample size here, more than 10 times the size of the EPA sample.
Well, let's hope that's true. You always wonder how much time they spend on these studies, but we've always known that natural gas is the cleanest burning fuel going right now. This really is just another feather in their cap that way. So in the fight between supplies of either coal or natural gas, I think that's a big feather in their cap to be able to bring that out and say, look, even if the price of gas does go up, don't switch back to coal. Look at the environmental benefits you're seeing here for natural gas.
Keith, we've got a trifecta of reports here this week. Here's the third one from Standard & Poor's Rating Services called "The Shale Gas Boom is Shaping U.S. Gas Pipelines' New Reality." What's that all about?
Well, that's exactly what I wrote about here about 2-3 months ago, where we realized all of a sudden shale gas is so everywhere in the United States that all these pipelines have been built over the last few years, and the latest one was called the Rex pipeline, a $4 billion pipeline that went from the Wyoming-Colorado border way over to Ohio. And gas has always been exported from the west to the east. The northeast has always been the big market for natural gas. It's always had the highest regional price on the continent. But what's happened now, Phil, is that the Marcellus Shale in New York, Pennsylvania, Ohio, has become the granddaddy of all shale gas deposits in the U.S. And there it is, right in the northeast U.S. It doesn't need to have, so that market no longer needs imports.
Okay.
So all of a sudden, a $4 billion pipeline is basically useless. And so now, fortunately, what these pipelines do is when they secure supply before they get built, they get take-or-pay provisions from suppliers that whether they supply it or not, they've got to pay the pipeline. So they have their revenue kind of locked in, and so they get their capital paid back. But the reality is that these pipelines aren't needed because everybody's got local gas now.
Keith, what's the summer going to bring for A, oil, and B, nat gas? Give us a quick peer into the crystal ball. What do you think?
Well, in oil, it's definitely going to be lower across the board.
Okay.
And the question is it going to stop here? If we don't get any coordinated central bank action for stimulus on a QE3 worldwide basis between the Americans, the Asians, and the Europeans, I think oil could see another 20% drop from here.
Wow.
Despite the fact that demand is pretty good. But it's a question of the financial derivatives side of the market,
sure,
which is quite strong. That's probably worth about $25 in the price of oil, is going to get liquidated out. And you're looking at now this huge new supply in the U.S. that is going to tip the balance of power potentially away from OPEC towards getting a more balanced supply side around the world. And so I think until investors kind of see how that really works out, then it's going to be very iffy to see oil prices pick up. Gas in the U.S., again, you could continue to see a very small increase in the price of gas, as you've seen over the last few weeks here in the States due to the increased power burn. But in Canada, Phil, I'm not very optimistic. I think we're going to have a very different market than the U.S. Our exports to the U.S. are down so much that we could, and our storage is so full up here, we could see gas go almost no bid in Canada. So I think in the next 6 to 10 weeks, it's going to be a very uncertain time for natural gas, which is going to put a huge strain, particularly on the junior producers, but even on the seniors.
Okay.
We're going to hit full storage here very quickly, and then you're going to get a call. Some companies are going to get a call from the pipeline saying, we're not accepting your gas today.
Wow. Keith Schaefer, editor and publisher of the Oil and Gas Investments Bulletin. He's online at oilandgas-investments.com. Keith, sure appreciate talking to you. Thank you, sir.
Phil, God bless you.
Thanks to our guests, Ross Clark, David Smith, and Keith Schaefer. And thanks to you for listening. I'm Phil Mackesy for AmericanManganeseInc.com. We're back next week with another edition of This Week in Money.
This Week in Money is a production of Howe Street Media Incorporated.